Thank you. Thank you, Zina. It's a great pleasure to join you all in Barcelona today. And I want to try to give a context for all of the thinking that's been going on in this conference. Because I think we're lucky to be living at this time. This period reminds me very much of the period 50 years ago when, at the age of 26, I launched out to create a venture firm at the time when neither venture nor entrepreneurship nor even technology were totally accepted. And those three forces together really transformed our world over the last 50 years. And we are living at a time when three other major forces are coming together now to transform our world. The three forces are: the first, a change in values. Wherever you look today, you see initially young people, but a much broader population now that doesn't want to buy the products of companies that are doing harm or to work for them. This has become evident to investors. And so we started to see about 10, 15 years ago, ESG investment begin to take off. The idea that you have to deliver not just profit, but in my words, profit and impact. Environmental, social, and governance impact. The sums of money that are flowing now because of this change in values are colossal. $40 trillion of ESG. Last time it was counted, probably well above that now. And when I led the G8 task force in 2013, to give you a sense of the growth, the number was 13 trillion. So we've gone from 13 trillion to more than 40 trillion of capital that seeks to achieve both profit and impact. And of course, I'm very much aware of the pushback to greenwashing, which ESG has engendered, and I'm going to come to that. But alongside ESG, you have today $3.5 trillion, trillions, not billions, trillions of impact investment that has the same intention as ESG, but measures the impact created. And I'll come to measurement also in a moment, but you have this major change in values, major change in financial markets. And over the last couple of years, we have seen $2.5 trillion of bonds and loans issued, where if the company borrowing the money achieves social or environmental targets that are preset in the bond or loan agreement, then the cost of borrowing goes down by 0.25% in most cases. And we see companies all over the world raising money now in ways through the bond market, in ways that are connected with sustainability. A quarter of all bond issues in Europe are sustainability related, 5 to 6% in the US. So massive force, and a bit like the force of entrepreneurship, which people didn't see coming when I started out on my career. This change in values has caught a lot of people unawares, and you still hear people saying, this is a flash in the pan, this generation will grow older, more materialistic, and all of this is going to change, but it isn't. And I have exactly the same feeling about this change in values that I did about the change from working for big companies to becoming entrepreneurs 50 years ago. The second, massive change is the one that this conference is focusing on, and that is the force of technology. Because if the microchip brought the revolution of the last 50 years, the leap in technology that artificial intelligence, machine learning, big data, augmented reality, among all of the technologies that you have discussed, promise to transform the business models of almost every company as it comes together with these new ideas about creating impact, the change in values and the arrival of new technologies that enable us to deliver impact globally in ways that humanity could never previously contemplate, are going to transform the world and lead to a disruption of business models that is very similar to the one that we have seen computing and the PC and the internet and the cellular phone bring in the last 5 decades. And I see business models being created now, and Tesla is probably the most visible one, but I see it at an entrepreneurial level. Business models that are being created that optimize, in the words of my book, impact, reshaping capitalism to drive real change, optimizing risk, return, and impact. Tesla could not have entered the automobile industry with a conventional combustion engine. The reason Tesla managed to get its initial customers before even the car was ready for sale was that many people felt that buying an environmentally friendly car was an important thing to do. And it helped Tesla to attract the superior talent it needed in order to compete with companies that have been established for 100 years or more, just as Microsoft and Apple competed with IBM. And it attracted the initial investors who put up 156 million of venture capital 22 years ago. And over those 22 years, we've seen Tesla transformed into a company that got to $1 trillion valuation and has changed the face of the whole automobile industry. But I see it, and you will see it in each of your different countries in the business plans that are coming forward. Business plans that transform education by training people for jobs in coding or data analysis and other subjects, vocational subjects too, and enabling them to pay for their education when they've got into a job. We're seeing it in telehealth, where we're able to diagnose quite accurately now illness in remote parts of the globe, from major cities that are tens of thousands of miles away. We're seeing it in fintech, where the model of banks is being challenged with impact ideas, where overdrafts are at exorbitant levels simply because those who have to use them are too weak to refuse to pay and don't have alternatives. And so we're beginning to see fintech platforms coming in to reduce overdraft rates for the more vulnerable populations, to match them to the real loss rate that is being achieved. It shouldn't be that you have to pay 10 to 14% for the loss rate that exists with overdrafts. And so we're beginning to see companies coming with 5 or 6% rate. And we're seeing it in clean energy, of course. We're seeing it disrupting, and the Ukraine war is spurring this, the ways in which we thought about conserving energy and driving new sources of clean energy. So when you think in terms of the change of values, which is taking us to create impact and profit, and bring that together with these huge leaps in technology, you can see just how powerful a revolution has already started. And the third force is probably the one that you're unaware of the most. And that is the force that technology has enabled transparency on impacts to gain. Up until now, we have measured profit, of course, and 50, 60 years ago, 70 years ago at the University of Chicago, academics began to measure risk for the first time. Until then, risk had always been in the background, just as impact is now in the background when business decisions were made. But Professor Moskovitz and others began to look backwards at how much certain stocks and bonds had gone up and down and say, look, this is an indication of their volatility in the future. Bonds go up and down less than equities, some equities more than others, and so on and so forth. And that measurement transformed the financial markets of the world, because that measurement brought new thinking, which impact is bringing now as it meets technology and drives a change. It brought thinking about risk-adjusted returns, which we'd never had before, that you can have a higher risk category of investment, like venture capital, for example, where I built my career in private equity, but that the high level of risk is more than justified by a disproportionately large financial return. And risk-adjusted returns brought us to the concept of diversification. And diversification meant that you could include venture capital and private equity and investment in hedge funds and investment in emerging markets in a portfolio, as long as you gave them the right weight in the portfolio. Now, when I started out, there was zero in venture capital in an institutional portfolio. 5, 6, 7 years later, it was 1% maximum that you could get. Today, you have institutional investors putting 20 to 25% or more of their portfolios in venture capital and private equity. And investment in emerging markets was enabled by the new thinking about diversification. And what happened with the measurement of risk is happening now with the measurement of impact. When you begin to measure the impact of companies, it begins to reveal things that you had never anticipated before. For example, if you look at the work that's been going on at Harvard Business School, which I've been privileged to chair, in the area of valuing impacts, the Impact Weighted Accounts Initiative, as it's called, and all its information is open source and available for all of you to use. You begin to see that a company like ExxonMobil creates $39 billion of environmental damage from its operations in a year, compared with Shell at 23 billion and BP at 13 billion. Now, what are the implications for investors? They're obvious. If we're talking of a carbon tax, ExxonMobil is going to be taxed on 39 billion. And if it doesn't want to pay the tax, it's going to have to invest heavily in order to reduce its carbon emissions. That's going to have implications for its profitability. So not surprisingly, you see in the Harvard data a correlation between companies that pollute more and a lower stock market valuation. And that's what's going to drive change. So when you're thinking in terms of your particular areas of technology, think about how they're going to improve lives and improve the environment. because that's where the premium valuations are going to be in the future. And this measurement isn't limited to environmental. Incidentally, it'll interest you to know that out of 3,000 companies whose environmental performance, environmental damage we measured over many years, over a decade each, 450 create more damage than profit in a year. 1,000 create damage equivalent to a quarter or more of their annual profit. 2,000, therefore, can migrate from a quarter or less to achieving net zero. So you begin to get insights that become extremely important, not only for investors, but for companies as they compete with one another, both on profit and on impact. The measurement continues with product impact. If you look at the products of Danone, the French food company, wonderful yogurts, $5 billion of pre-tax profit a year, $8.5 billion of health damage because of sugar content. You compare it with General Mills, $2 billion positive health impact because it's selling fiber rather than sugar. You can extend it to diversity. Big data and artificial intelligence and machine learning enable us today to compare the demographics inside and outside Amazon facilities and Apple facilities and put a salary level, a remuneration level to them. Amazon emerged with $6.5 billion of diversity debit, meaning individuals who were excluded on the basis of gender or ethnicity, and the remuneration they would have got, which we viewed as the loss, the economic cost to their community. You compare it with Apple, $2.5 billion diversity debit. Take it as a percent of wages, Amazon at 16%, Apple at 25%. And so you can begin to see how impact transparency is going to transform the flow of capital and talent. And it's happening right now. The SEC in the United States has put on the table already, as some of you will know, the mandatory disclosure of all environmental impacts, including supply chain impacts. There's a huge fight going on now, and now you're aware of it, you will notice it going on between some parts of corporate America, like the fossil fuel industry, that don't want this transparency to come about and are suing the SEC, saying that it doesn't have the power to bring this type of transparency into effect. It has to go to Congress. On the other side, you have 1,500 lawsuits or more in the United States against companies that are polluting. And so you see the US moving in this direction. Europe is moving even faster. The organization responsible for financial accounting across the whole world, which is based in London, the IFRS-F, some of you will be familiar with their financial accounting principles, has established an international sustainability standards board to standardize the metrics of CO2 and all other environmental and social metrics. The effort at the Harvard Business School has spun off the International Foundation for Valuing Impacts. Within the next 2.5, 3 years, you will see standardized values being used by investors. And so I leave you with this thought. Just as entrepreneurship and technology and the new professional venture capital industry came to drive the tech revolution, the change in values, the leaps in technology, and the arrival of impact transparency are going to be transforming our whole economies. I hope that as you talk of applying the scientific advances that you are leading, that these words will inspire you to think in terms of the impact that each and every one of you can have on improving lives and our planet. Thank you.